Morning, everybody. I'm Bill Boyer, and I'm one of the founding shareholders of BoyarMiller, and I want to welcome you to our webinar on the current state of the capital markets. Let me start with why we're doing this. We really feel like it's time to start shifting the conversation. We've all been barraged and inundated with COVID-19 and coronavirus and politics, and we just feel like it's time to begin a shift in the conversation to our markets and our business world, and how are we going to deal with what's ahead for all of us, particularly those of us who play in Houston and are affected and also make a living working in the capital markets. So I'm going to introduce Lindsay Fincher, my colleague, who's on the screen, and Lindsay's going to facilitate Q&A at the tail end of our hour. So you have a Q&A feature on your screen. So if you have questions, please send them. We're not using chat, so look for Q&A. Send your questions to Lindsay, and she'll manage our questions. I want to introduce our panel. It's been so kind to take the time to participate with us. Dylan Knutson, who's the Houston CEO of BBVA, happens to have been our firm's bank for the entire 30 years of our life, and we appreciate that relationship more than you know. Scott Winship, who's one of the managing directors of Gulfstar Group. We've done a whole lot of work with Scott and his partners and team through the years, working in the middle market, private equity and M&A. And Tom Fish, my longtime friend back to the last Great Recession, who's a manager director of Walker Dunlop and one of the real top real estate finance professionals in our community. So thanks to all three of you for being willing to step out early in this conversation and share your views. So today we're going to just tell a little story. The flow of this hour will be to sort of take a look at where we all were in 2019, what the year looked like for everybody in their industry and their business, what their thoughts and attitudes were going into 2020, what the beginning of 2020 looked like. Then we'll talk about today, sort of March to today, what we're dealing with, how we're spending our days, what we're focused on, and then most importantly, what we see ahead. What's the prognosis? Does the best that we can make it without prediction. So just sharing of, for the four of us, and then we're going to leave time at the end for Q&A. So again, send your questions into Lindsay. So when we get started, why don't each of you introduce yourself and your organization, and we'll start with Dylan, and then Scott, and then Tom.
Great. Good morning. Thank you for having me. I appreciate a good reason to shower early, and I did my hair today, wore a button-down shirt. So thank you for that, Bill. So my name is Dylan Knutson. Since I'm new to the group, I'll share a little bit about who I am and where I came from, and then tell you a little bit about the firm. So I grew up in Fargo, North Dakota. So I'm sure some of you have seen that on a map or seen the movie. I grew up there. It was a great place to grow up. I made my way out of North Dakota in early 2000s. I moved down to Austin, Texas, where my brother and I were in the restaurant industry. After a few years of late nights in the restaurant industry, decided I'd put my finance degree to work, and got into the financial sector, actually doing commercial real estate in Phoenix, Arizona. I was working for a bank in Phoenix, and one day I'm sitting at my desk underwriting what was then or would be the bank's last land load, and a finger came across, turned off my computer screen. I looked over, somebody was grabbing a shred bin, and now I work for the FDIC. So that was my intro into through a bank failure and everything that we all dealt with during the Great Recession. I then transferred into an investment bank out in Phoenix, was an investment banker for a few years before finding my way to BBVA. The firm I worked for, the principal is actually on the National Advisory Board for the bank, and he suggested I check out all the great things that were going on. BBVA had just acquired Compass at that time. So I picked up, moved out to Houston, Texas, where I started working for the bank in credit capacity in 2010, 2011 timeframe. Came up through the ranks in the credit world, was then shipped back to Phoenix and managed our healthcare book for the West Coast out of the Phoenix office. In 2017 was moved out to Southern California, where I managed one of our offices in Southern California. And then in 2018 received a call from the head of our Texas region asking why I had a 512 area code. So I had to back the whole story up, explain to him that I'm a huge Longhorns fan, used to live in Austin. My dog's name's Austin. He may make an appearance here. And he said I needed to sit down. I'd lost all leverage in the conversation that was to come. And so I ended up moving to Austin, Texas to take over our Austin office in December of 2018. Spent 2019 in Austin, and then was fortunate enough to get the phone call to come back to Houston here in December of 2019 and take over our Houston office. So the Houston office, what kind of rolls up to me, my world is commercial banking. So companies ranging in revenue from 10 million up to 500 million. And then our global wealth book, which is individuals, high net worth individuals, really kind of starting at the 1 million range up to kind of sky's the limit. And so within those worlds, we do everything from, managing capital acquisition loans, working capital lines, and then all the good fun stuff, which is the treasury management, corporate cards, FX, all that type of stuff. So that's who I am. And I'm representing, I think, Dina Anderson, who's your banker. We've appreciated the long-standing relationship, and I know she's enjoyed working with you guys. And so thanks. I also have, just so you guys know, I have a cat named Loki, a wife named Jessica, and a dog named Austin. Any of those three may show up at any point during this conversation. So
lock the door. Scott.
All right. Good morning, everybody. I'm Scott Winchup. I'm a partner at the Gulfstar Group here in Houston. Gulfstar is a middle market investment banking firm. The majority of our business really is advising family-owned businesses and entrepreneur-owned businesses in sales processes, either minority deals or majority deals. We also do quite a bit of financing advisory, be it debt, equity, or combinations thereof. The types of businesses, again, characterized very, very strongly by, non-institutional owned, family private businesses, but size-wise, typically range from 25 million to $350 million in revenue and enterprise value. It tends to tack pretty closely together. As an organization, we cover a pretty broad spectrum of industries. No surprise, being in the 713, that historically we have done quite a bit in the energy complex and the industrial complex around energy. We also do quite a bit in what we describe as general industrial and services, technology, and consumer products, which is the vertical that I run at the firm. So given that breadth of industry coverage, I think we've got a pretty interesting perspective on what's going on right now, really from the ground to the consumer endpoint. So it's been helpful as we've been having varied and numerous discussions with our customers and clients about what this all means.
Great. Thanks, Scott. To you, Mr. Fish.
Okay. Thank you, Bill. Tom Fish. I'm a native Houstonian and been in the real estate finance business since 1987, working on all aspects of the real estate capital stack, debt to equity, and everything in between. I had spent 10 years, I'll just give you the last 10 years so I don't bore you to death, but spent the last 10 years at JLL, helping to build their national capital markets platform. And when we announced the merger with our very good competitor HFF in April of last year, it gave us the opportunity to maybe pick our head up and look around and see what we wanted to do. There was a company called Walker & Dunlop which is the third largest originator of GSE debt in the country. That's the Freddie and Fannie and HUD debt. And they had 35 offices around the country, but they were missing a presence in Houston. And Houston is the third largest apartment market in the country in terms of number of units. So it was a really nice fit that we and took our whole team, including myself and Tom Melody and Mike Melody and Paul House and Jonathan Payne and a great other cast of people, and opened up the office for Walker Dunlop. That was in August of 2019. So pleasure to be here. Known Bill forever, great guy. And this is usually a breakfast meeting, so my cholesterol is down at least 10 points this morning from not having the eggs and sausage and all the goodies that we would normally have. So I appreciate that, Bill. We're healthier because of you. And,
right.
and the
have a protein bar. Have a protein bar. All right. Well, let's launch a launch point for our conversation. Let's take a quick look at 2019, and I'll start because it's simple and it's pretty. So 2019 for our firm was a record year. It was a record year in terms of transaction volume, revenue, profits, size of our firm. We grew to the highest number of professionals that we've ever had in our 30 years. It was sort of the perfect storm of low interest rates, of flood of capital, healthy banks, people looking for deals and deals looking for people. And so it was as good as it could get for us. And, we have a natural hedge in our business we have a business group and a litigation group. And typically when things are really robust in the economy and the deals are flowing, the corporate and finance and real estate side of our business is a little bit more hectic than the litigation side. And I'll talk a little bit later about how that flips in difficult times. But it was great. It was a great year for us. And we, as we looked at going into 2020, we had some real guarded optimism, and we'll talk a little bit about that later, and how that optimism played out early and as we got later into this year. So great year for us. How about you, Tom? I mean, you made your big transition last year.
Yeah, I mean, we've been in a 10-year cycle of real estate capital increasing, the tide coming in every year a little bit more and more. And we were coming off a 2019 that was fantastic. We did make a transition, and every time you make a transition as a service provider, there's a little bit of downtime. But we really started plowing through that and getting ramped back up. And in our business, everybody sits around like a lot of other businesses and says, "What inning are we in? What inning are we in?" And we thought anywhere between the 7th and 8th inning, and then some of the indicators in our business of what inning you're in there was a couple of big sales, one of which was HFF to JLL, and the other one was Easthill, and they're really good at buying and selling their own companies, and that might have been a canary in the coal mine. So, but no, they were great years for us. Great momentum.
And Dylan, how about the bank?
So 2019 was actually an interesting year, and it started at fourth quarter 2018. There was some concern actually rolling into 19 because we started seeing some liquidity, crunches and some cash flow covenants triggering in the fourth quarter of 18, and had us going into 19 thinking, maybe third, fourth quarter 19, first quarter 20 was when we were going to start seeing some sort of a downturn. And ultimately what happened was, as the Fed reduced rates in the first quarter for no apparent reason, because 2018 was the best year we'd had in a decade, all of a sudden cost of capital started coming down. Companies that were maybe overspending because they were used to this trajectory of growth started cutting back on new equipment and bigger buildings. You saw Ford lay off a bunch of people in the fourth quarter of 2018 for, again, no apparent reason, but we all know why. They're chasing earnings. And so 2019 actually started out with us what I would call the war on deposits. I mean, every bank in the country was going out trying to pick up deposits, pick up treasury. And as rates continued to drop, what may be counterintuitive is as rates drop, we would actually prefer to be loading the balance sheet with debt. We lose our margin on deposits. You generally start picking up some margins on the debt side. And so the strategy literally flipped halfway through the year and going out and helping people, providing capital. But then the challenge there was, as you mentioned, there was so much capital on the streets and no place to put it that we as a commercial bank started competing against family offices, VC money. Private equity was, instead of going takeover mode, we're coming in at 30%, 30% holds and being patient and just letting companies run their business. And so 2019 for us was a challenging year. But by the fourth quarter of 2019, we started seeing things normalize, which we thought was going to really catapult us in to 2020. So for all the reasons that you loved 2019, those were all reasons why it was really difficult for us.
How about you, Scott?
Yeah, kind of flipping back to the front end theme. We've been around in our current form for 30 years, and 2019 was the best year that Gulfstar has had as an organization in terms of deals done and revenues, and candidly, I think momentum as well. There all of the inputs that impact activity in our business were going the right direction. Private equity has continued to raise ungodly amounts of capital, which has put an upward pressure in a good way on all of our deals. Receptivity to transactions was fantastic. We had many situations where we kind of had to force rank people out of processes, which is an interesting position to be in. So it was a very good year. We finished the year with a lot of optimism about 2020. We are all kind of naturally paranoid people, so we weren't whistling past the graveyard by any stretch. But the key metrics that we look at in terms of capital availability, financing, receptivity, chatter and dialogue were all flashing the right signals as we crossed the finish line in December.
So Scott, as you went into 2020, what was, I know your business is difficult to budget, but what were you thinking in terms of what 2020 was going to look like? Was it more of the same, or did you have some reason to be concerned because of some leading indicators?
Yeah, so kind of thinking about it from a budgetary standpoint, we're always conservative inside the organization and didn't plan to beat our historical best year sequentially 2 years in a row. But from a underlying business perspective, the backlog, the deals that were signed up and in process, it was a continuation of the momentum that we saw in the fourth quarter of 2019. So like we tend to operate in kind of cautious optimism mode, even in the best of circumstances. But we printed a deal early in the first quarter, which you were involved with, and ironically, right before everything kind of broke loose here with this situation. But we had every reason to believe, particularly just given the buoyancy in the market from a private equity capital deployment standpoint, that we were in store for another very decent to good year in 2020.
And Tom, what was your organization looking at as you were sort of doing the planning for 2020?
Sure. Well, we're categorize it as in startup mode, but with a nice balance sheet. We have a $90 billion loan servicing portfolio that throws off a fair amount of cash. And when we planted our flag in Houston, our goal was to really ramp up and recruit and create a bigger presence here. So the only headwinds that we faced within our we didn't really face any industry headwinds because there was plenty of capital out there. We were looking at the energy market and saying that might be a bit of a headwind for Houston, but because we can go after different product types, and with multifamily being among them, and still Houston being at a 3.5% unemployment rate, we felt like there was a lot of ways around any potential headwinds on the energy side. So we were full blast.
Dylan, how about BBVA coming into the year?
So we started off 2020 with our new 5-year strategic plan, which amongst other things, we're the 4th largest bank in Houston. Our company is headquartered in the United States here in Houston. So globally, all eyes are on the United States, given what's going on in our market. And in the United States, all eyes are on Houston. And so the goal was, and still is until things change, to double the bank in a 5-year period through organic growth and hiring a ton of people. And so we went to work. We had a great pipeline built from the 4th quarter, similar to what Scott was seeing. We had a great momentum coming into the 1st quarter. No issues in sight. We were really looking forward to getting into 2020. We staffed up. We hired a ton of bankers, getting ready for all the growth that was to come. And we executed on it. Our 1st quarter was the best quarter that our region's seen in over a decade. And so January's humming along, deals are closing. February's humming along, deals are closing. You start hearing the noise of what's going on. March rolls around, and then it's like the great theologist Mike Tyson says, everybody's got a plan until you get punched in the face. And so that's where we are now.
Well, let's go there. I mean, for us, I think we ended the year on such a sort of high note. We were a little cautious about 2020, but we did certainly project growth because we've had growth 29 of 30 years we've been in business. We had a couple of our large clients pull back on the M&A side for reasons unrelated to the economy, just scale and getting things done that they had planned to do. And but we did, we thought that the private equity and M&A business, the real estate business, the capital markets would stay open and robust. And what happens there is there's really insufficient disruption to really drive litigation. As we've seen through the years. So, everything in our real estate practice is always steady. And so we were really pretty confident about that as well. But so it's been we had a good January and February, and then here we are today. So, well, I'd love to hear what your days are like, what you're seeing today, as we're all coming in from our home offices. So why don't we just talk about what it's like today and what you're seeing today? Scott, why don't you lead us off?
Sure. Lots of talking. All across our partnership, we're busy on the phone, and we have obviously clients that we're spending a lot of time with, navigating the daily waters and assessing and reading and reacting to where they are, really kind of on a minute by minute basis. We also have private equity folks calling us daily, trying to get a sense for what's happening with our deals, what we're seeing and hearing out there, and also I would say from the financing community the same. And I think the challenge for all of us is that until there's some modicum of understanding about the durational character of this issue, it's like knocking the puck around. Nobody has hard answers to any hard questions because we simply just we can't analyze scenarios and potential pathways until we understand what the timing equation looks like. And so I'm encouraged by the fact that the level of dialogue is very, very high. I mean, people are not sitting on their hands at all, but I think like everybody else, frustrated in that, we don't know acutely how this issue is going to impact our clients until we get to an endpoint, and we do not know acutely what the market receptivity is going to look like until we get to a receptive market. I mean, I think it's fair to say that we're expecting some pain in terms of fluidity of the market when it does reopen. We're expecting a different viewpoint in terms of how businesses are looked at from a valuation standpoint. We certainly do expect that the businesses that show resiliency, which will be measured by the ability to come back from this and demonstrate a quote unquote normalized business model or semi-normalized business model with some substantiation, those businesses are going to continue to find a lot of interest in the market. And those that have a longer term structural challenges, and I think we know some of those sectors, there are going to be some very difficult realities to face for those types of businesses. So I guess to stop and sum it up, very busy, which we like. Just being fans of being able to analyze things to a point where we can render an opinion. It's hard to do that right now, and that's a tough reality at the end.
So Scott, the deals that you had in your pipeline, did they all just get stopped, or
Yeah.
They did?
They did, and there's just functional issues like how do you diligence something, right? If you can't get there to diligence it, and I think where we're not really concerned about the equity side of the equation, Bill. That's gonna be there because again, we've talked about how much capital there is out there, and I think what you're going to see is that there's going to be probably a structural change. There'll be a lot of minority deals, and a lot of kind of structured equity deals that repair kind of timing issues. But there's probably going to be less activity on the buyout side until people really have a sense for what the financing market looks like. That's probably the thing that has us concerned the most, is the financing market, because we don't really know what the downstream effects of deferments and forbearance are. Is there a structural credit crisis looming as a result of all these things that are going on right now? There's a lot of discussion around kind of leverage and pricing, but that's like looking at a bid ask screen before in a pre-market session. It just moves around until a trade hits and then the number's established. Anything that anybody's talking about right now in terms of levels, financing levels, terms and pricing is just kind of it's a guess or a statement to make a statement, as there's no empirical evidence to support that until we see trades.
So are you hearing from your deals that you've closed in the last, say, 18 months in terms of already talking restructuring, or are they just talking to their lawyers?
Well, I would say that kind of depends on the industry. So on the consumer side, our businesses, that we have sold or financed in the last 18, 24 months, by and large, are doing pretty well, except for the restaurant deals. Obviously, that's just an incredibly difficult challenge. But a lot of them, particularly in consumables and food in particular, they're having record months for, I think, reasons that we all understand. On the industrial side, where you've got more balance sheet complexity and working capital issues and fixed asset profiles. Yeah, I mean, there's discussions that are starting to be had and will be had. And as you might imagine, we have a restructuring practice. Brian and Cliff are doing their calisthenics right now because we're anticipating a pretty heavy amount of activity there.
Sure. So Tom, how are you spending your days? What are you hearing from your clients? And
yeah, sure. Well, we've gone from, as a lot of you guys, gone from being a financier to a therapist to a large extent. Over the years, I've every now and then get accused of being paid a lot to do very little, and now I'm getting paid nothing to do quite a bit. So, this is it's a weird time in real estate because depending on your asset class, you're just waiting month to month to month. You're like a insecure little high school kid who's throwing a party and you don't know who's going to show up, right? We sat around holding our breath to see who was going to pay April rents. Well, multifamily did really well in April. It probably paid about 90+% tenancy. Retail, if you were getting 50% of your retail tenants paying, you were on the high side. Most of them were in the 20s and 30s. Office and industrial did okay, but the definition of credit tenant is out the window because there are tenants with plenty of capacity on their balance sheet who have said, "I'm not paying." So we're spending our time just trying to monitor our clients and what they're going through. We're spending our time with helping them go through any kind of forbearance process that is required. And as you guys know, I think the lending community as a whole is being very realistic and very smart about how they are going about determining who needs relief and who doesn't need relief. We'll go into more detail about that, but whether it's working with banks like Dillon's or the insurance companies, the agencies, the Fannie, Freddie, and HUD have already come out with I think, a very smart policy on forbearance that allows for forbearance, but is discouraging of it because there are strings attached, and that's kind of the way it ought to be. The big unknown right now is the CMBS market. That has been typically a very inflexible financing vehicle because it's governed by these RIMIC laws, and we are starting to see and by the way, that's where the most trouble is because they tend to be retail and other property types, but they're a huge source of retail debt, and so that's where really there's an extraordinary amount of pain right now, and that pain is going to continue. But we are seeing some ability to modify these very stringent rules so that everybody can approach this from a really logical basis. And so that's how we spend most of our time now, is trying to help people out with that.
Thank you. So Dylan, I saved the best for last. How's the world of a PPP lender?
It's been interesting. So March 16th, we kind of focused our energy in 3 areas. March 16th, we sent everybody home, and we all got used to this work from home environment. And the first couple of weeks were trying to create some new normal that felt like it felt 2 weeks earlier, right? So we continued to have our meetings, continue reaching out to clients. For our clients in this world, we've been doing things that you would expect, like, payment deferrals and waiving fees and, providing covenant holidays for folks, like Tom mentioned, who are having issues collecting rents. And there's no hiding behind what's to come, right? I mean, if you thought that the first quarter looked a little rough because you lost 2 weeks in March, wait till you see what happens when you lose April and May and June, and who knows how long this thing's going to go. Within our communities, I think the bank really stepped up. We've provided over $35 million in funding to health organizations across the world. In Houston, we're providing $3.7 million in funding to local nonprofits that are kind of first responders who are dealing with folks who are impacted. And then, I saved the best for last, which is the Payroll Protection Program. So, here's my stance on this: it's that at the end of the day, whenever you get into very difficult times as an organization, and any company is going to deal with this, you have to do, one thing first, and that's look back at your mission and look back at your values, and then every decision you make moving forward have to tie back to that. So the bank's mission is creating opportunities. Our values are customers come first. We are one team, and we think big. So on April 2nd, when we all watched the White House briefing, which I'm sure everybody saw, when the world was told that the PPP is baked, the banks are ready, and you all get to submit your applications tomorrow at 8 a.m. We did everything in our power to be ready to catch those applications and figure out what we were going to do along the way. And I can't get into specific details and numbers around the apps that came in and the work that was done. But what I can tell you is this. Our organization has completely changed over the last 3 weeks. It has been an all hands effort. Every banker in our organization, in my world, at least in the commercial and wealth world, has been intimately and directly involved with collecting these applications from their clients. Our staff has all been converted essentially into the folks who are inputting all of these applications into the system. And then even all the way to our marketing ranks have been trained on how to create, docs and submit, PPP applications into the SBA. And so I think for us, what's been the most challenging is that while we tried to be first to market in supporting our clients, knowing that at the end of the day, us working 24, and this is real, for 10 days, 11 days, our staff was working 14 hours a day with the exception of Easter. And none of that matters because there's still people out there who need assistance and they didn't get it. And so they've got employees now who are struggling, and they're trying to figure out a way to keep people employed. So there's no reason to sit around and bang your chest about how great of a job you did, or focus on the folks who've struggled because maybe they're larger and it's just harder to figure all this stuff out. At the end of the day, it's just not enough. And the 349 billion was estimated to be about 1/5 of what the actual need was. We blew through it, and here we are getting ready for round two. So I think the most difficult thing for our people is that we pride ourselves on being advisors to our clients and really digging in and helping them through things. And in this specific scenario, we really had to just put our head down, collect information on behalf of our clients, submit information on behalf of our clients, pre-fund loans on behalf of the SBA, and kind of stay out of the advisory part of all this because the guidance was changing so much that, as you can see, it opens up a ton of risk in what happens if things don't go as planned. So the good news is, we again, I can't really get into it. What I can tell you is we've funded more of these things in our market share in every region that we're in. I think the team did a great job. I'm incredibly proud of what we've done as an organization and what our people have done. And we are, as we sit here right now, ready for round two. We continue to process applications. We got them in the queue. We're ready for the SBA to say go, and then we'll go for round two. And then what comes up next is, more conversations on the payment deferrals, covenants, holidays, which we expect to be an issue. There's the Main Street lending program that I'm sure people are reading about. There's really no guidance there. The pushback from banks has been that they would like to use SOFR as the index. That's not going to work because SOFR doesn't work yet. There's some issues around how the structures are laid out. I think they've got a May 1st start date, but odds are that probably gets pushed out. And then there's some state programs that I think Texas is working on with Goldman and Lift Fund. And so there's other stuff that's coming. And at the end of the day, we're going to do whatever we need to do to take care of the people who need it. So that's what's going on in my world. But when you say PPP, you may see me get like a little tick or a little PTSD is coming along with this one. So I will, and I would like to say for the industry, I know it's easy to focus in on a bank or banks or the industry as a whole, but I just want everybody to remember this is not our program, right? We are doing everything we can as an industry to help pre-fund on our balance sheet grants provided by the SBA with limited guidance and even more limited guidance on how these things get forgiven. And so we're all sitting here hoping that this works the way everybody said it was, because we funded them, and every other bank that's putting these things out, they're funding them on their balance sheet. So we hope it works like it's supposed to.
Well, thanks, Dylan, for that insight, because as one of your customers, I know what you're going through, and our days as advisors have just completely flipped. And what I think about is the hours of the day that I sit in front of the Zoom meetings internally, as well as dealing with our clients who are obviously in a variety of industries and different conditions. Some industries are actually okay. I saw some statistic last night that that the increased sales in grocery stores has offset the loss of sales in restaurants. Something that came out of CoStar, and you think about where it's shift. There's some shift of money that's going on, and as money is flooded into the system, it's still moving. So some industries are actually doing okay. We have clients that are in the cell phone business. They're not selling cell phones, but they're open and, for service and repair, and they're able through some of these programs to keep their people employed. But my goodness, without repeating everything y'all said, my biggest concern is sort of how are we holding our culture together? How are we keeping our people together? How are we managing anxiety? So I spent a lot of time during the day and the things that I'm involved in, both in the firm and in the not-for-profit world, worried about the health and safety of employees, mental health. How are people doing? How are we managing anxiety when there's not a lot of work to do and people are concerned about job loss and income loss? And then, so to me, there's, it's the anxiety and the fear, and yet the inability to actually sit down with people, the social distancing and isolation. So that affects us, all of us, every day. It's unnatural as humans. And when your only ability to take care of your people is on a screen or on a phone, it makes it that much more difficult. So we employ 47 people at BoyarMiller, and I sort of worry about everybody every day and their families and how they're getting along. And somebody said early on, before we got onto the public broadcast of this, that this is going to do wonders for the office market at some point, because everybody's going to want to get out of their homes and go back to their offices. So that's what we see. I spent a lot of time with our chairman, Chris Hanslick, sort of thinking through how does this impact strategy, and how do we reset? What's the reset button to hit? How can we possibly forecast our financial performance, and we'll keep our supply stable, because we don't want anybody going into the world to try to find a job when there won't be any jobs. So it's that conundrum of trying to manage your best practices in your business with taking care of your people. And our culture is such that we're going to certainly, like you said, Dylan, take care of your people, and our clients and our customers. And I think that's probably the same for the 150 people who've dialed in this morning, who are all facing the same thing. And it's, one of my big concerns about the impact of today is mental health, and the mental health, impact it will have on our mental health system. I do a lot of work in public education and public education reform, and I'm worried about our schools being closed for the rest of the year, and the impact that's going to have on families and things of that nature. But so with that backdrop, and sort of picking up on what Scott said about, it's like, I think it's the analogy for me, this conversation is going to sort of head into like nailing Jell-O to a tree. But we have to start somewhere. And so why don't we sort of start, Dylan, with what do you and your team see ahead, and what's the thinking, without asking you to disclose sort of confidential information? What for BBVA?
So I've got a couple of questions I'll address during this comment. I think what's really important right now is communication, and being realistic with just the reality we're in right now, and thinking about where we're at today, facing it, dealing with it, talking about it. We all know that it would be virtually impossible to not have some financial impact over the last, month, 2 months, and looking forward. And so as people are talking to their financial institutions, I think they just need to be very honest with what's happening and get ahead of what's to come. So, for example, if you think you're going to have, covenant issues for the first quarter, now's the time to reach out to your bank and say, hey, obviously my revenue's been impacted by this, expenses are this, yada, yada, yada. This is where I think we're going to come out, and we're going to need some help. And I think that you're going to find that the financial institutions are going to be there to help you out, whether it's, getting principal deferments or principal and interest deferments, getting covenant holidays. And the really important thing about getting ahead of that is in 7 to 22 days, we're going to start getting everybody's first quarter financials. And when that wave comes in, this is a capacity issue, right? So I just told you that everybody who works at our bank is doing PPP loans. And when it comes time to deal with the portfolio management and all these things that are coming up, it's going to be harder and harder to deal with them if they're coming in massive waves. So to get ahead of it is going to be really, really important. The other thing is, somebody had asked, how is this going to impact our underwriting standards moving forward? I can tell you that my managers on the team are all, they're sitting here and they're furious about this COVID thing, because they were, like I said, we're ramping up. We had a great first quarter coming, and they still have a lot of great companies that they'd like to help right now. And we've got companies with great cash flow, low leverage that we do anything to move over. The only reason we can't is because we literally don't have the capacity in our underwriting centers to get through, this process. And so I think a lot of what we're going to be doing is just trying to stay in contact with people, help advise them on how to get through this. A lot of people have these PPP loans out now with other banks, even if they're in the middle of a banking transition. And so as far as what underwriting standards are going to look like for us in May, they're going to look just like they did in January and in 2019 and 2018, we don't really change. Good times, bad times. We kind of look at the world the exact same way. What's going to restrict us right now is going to be capacity to get stuff done. And then when you talk about kind of the 5 C's of credit, character is going to be really important right now. We're going to want to see how people handled 2008 and 9 and 10. And we're going to want to see, how they survived the last time this happened. And it's going to be really important that our bankers have very strong relationships with their clients on a personal level, like know who you're working with. I like to say, inspect what you expect. Make sure that we know exactly what we need to do moving forward. And so, I think honestly, I know this is going to sound a little bit crazy, but I do still think that there's some upside in the year. I think there's always going to be folks who have cash is king. Your balance sheet's really important right now, both on the individual side and on the commercial side. I still think there's going to be ways for us to help people out. There's going to be people who are going to take advantage of this opportunity. I, for one, I just moved to Houston. I'm buying a house. I'm like licking my chops right now. There's a lot of opportunity out there for folks to do what they've done. If they've managed their business the right way and they've got a good balance sheet and they've got a good staff, opportunities are going to come up, and we want to be there to help them out. On the wealth side, there's a lot of folks that want to get back into the markets now. There's a lot of folks who are going to be reevaluating their plans. There's going to be a lot of insurance opportunities that come up out of this. So I still do think there's a lot of positives. But like everybody else, we just don't know yet what it looks like. We just know it's not going to look very good for the next, call it 2 quarters. I do not think that this is something that fixes itself the day that the president and all the governors in the country say, okay, you can all go back to work. Because I think if Governor Abbott lifts everything tomorrow and every city complies, I don't think any of you are going to a movie theater to watch a movie. So this is going to take a long time to get through, but it is what it is.
So Scott, you gave us a little bit of a window into what you were thinking, but take this one.
Sure. I spend a lot of time watching CNBC. I have CNBC in my dreams right now at this juncture. And every day you watch CNBC, 500 times a day, people are talking about the shape of the recovery. Is it a V? Is it a U? Is it a W? Is it an inverted square root? It's kind of silly. The one thing that people aren't discussing is, is it the dead worm, right? The flat line that goes out forever. And so this is going to end right? We all know that at some point in time, this is going to come to a conclusion. What we subscribe to and always have as an organization, and in good times and bad, have these conversations with our clients, is to always be in motion, right? Is to always push ahead, because the one thing that the position you don't want to be in is on your heels when there's an opportunity out there. And so, regardless of the May, June, July effect that the situation may have on the business, the one characteristic that all of our clients have is they're very good, very viable businesses that have a reason to be, okay? And in this situation, they will move past it. And we want to make sure as advisors and opportunists that we are in the best possible position to take advantage of those opportunities when they do materialize. And so I think, again, kind of, tying back to a previous comment that I made, we are encouraging, enforcing, massaging, any other word you want to throw at it, consistent communication, forward progress, doing the work on all of our transactions, and including a lot of dimensional analysis that we would not otherwise have had to do to ensure that when the light shows up, that we are in a position to capitalize on it, and or just be in the best position to take advantage of it. That's our obligation to our clients. I think that's probably a viewpoint that everybody in this call shares. And so I don't think there is any benefit in sitting on your hands or moping. That set of characteristics doesn't describe any of our clients, right? They didn't become who they are because they're influenced by challenges. They take challenges straight on and build businesses that become value generators. So I think that's what we're doing. Our days are very occupied by forward motion and the progress that we can make under the circumstances that we're in.
Awesome. Tom?
Well, we're still making loans out there. The predominantly the agencies, Fannie, Freddie, and HUD, are still in business and still making loans, albeit a little bit tighter underwriting, a little more structure to them. But the one thing we can count on as a people is whatever we think is going to happen, we're going to be wrong, and we're going to be wrong to one extreme or the other. So, you think we're going to fall off the world, we're not. If you think everything's going to be just fine, it's not. The answer is always going to be somewhere in the middle. We're already seeing, as I'm sure you guys are, we're seeing rescue capital already being formed to take advantage of these, draconian opportunities that are surely to be around the corner. Well, we all saw in 2008 when too much rescue capital gets formed, there's not much, that the cost of that capital goes down, and there's not that many opportunities. So the liquidity is out there. I think underwriting is a question. Dylan, you mentioned underwriting a little while ago is not going to change on y'all's. I think in our business, it's going to have to. I think they're going to have to take more risk on underwriting, because you're not going to transact if you underwrite the way you used to, because there's just going to be too many holes in the rent roll and too many inconsistencies. If you look at, it's funny, you alluded to this earlier, Bill, for every different property owner we deal with, they have an answer as to why their asset class is going to be better after this thing is over with. So, the office guys who were always fighting the less space per person are saying, hallelujah, now we're going to have to socially distance everybody, and we need twice as much space per person as we did before. And oh, by the way, my wife is going to send me out the door now at 8 a.m. and not open it back up until 6. So you better get out of here and go to your office. The retail guys are, I think, going to have a fair amount of issues with a lot of these big boxes or big tenants who were, let's face it, there was a lot of retailers that were part of the zombie class. They were the Walking Dead, and this event is probably going to expedite their demise. But all this online stuff that we've all been doing, even more and more so in this crisis, I think we're going to come back to a phase where we crave that interaction. We just will. It may take a while. The industrial guys are telling us we need an extra billion plus square feet of space because now of the acceleration of e-commerce, and then the multifamily guys are saying nobody can afford to buy right now, so everybody's going to rent. So everybody's got their the hotel guys are still trying to formulate their response, by the way, because there's not a really good one there. But I think we're going to be back hopefully sooner than any of us thinks. My dose of cold water is I am worried about this city and the energy business. That is the one thing that I just can't get my head around quite yet, but also instinctively feel like as fast and as bad as it's gotten, maybe by 2022 it could be quite the opposite. In 2000, Scott, you tell me, but in 2009 we were at $28 a barrel. By 2012 we were at almost 100 or something like that. Am I on the right track there?
Yeah, you're on the right track.
Yeah. So maybe that's the shot in the arm that Houston's going to have on a relatively quick basis that helps us.
Yeah, Bill, if I can just clarify one thing. So in my world, we're going to peel out energy and we're going to peel out commercial real estate. And so when we talk about underwriting, really not changing, we're cash flow lenders. So we're looking for low leverage, below 4 times coverage, good cash flow coverage, some liquidity on the balance sheet. And we do, our real estate is owner occupied real estate. So it's, people in their offices. And so that's why when I say it's not going to change, our underwriting guidelines and the credit policies, they don't really waver. And that's why 2018-19 were so difficult for us, because we weren't stretching on term and amort. We were still requiring personal guarantees, and we weren't financing SPEs. We're just working with people who, we want them to make money, pay us back, not too fast, right? But pay us back. So that's why things really won't change on the underwriting side from my point of view. Now, in the energy world and in the real estate world, there's going to be some pretty significant changes, at least in the short term.
Yeah. And Bill, I'm sorry to jump back in here, but I want to acknowledge what you said a little earlier about the whole mental health aspect of this, because it is important. It is important that everybody, whether you believe we're doing the right thing or the wrong thing by all of this, it takes its toll, and it's something we all ought to be really aware of and approach as much concern as anything. I know we get on a call. Our team gets on a call every single morning at 9 a.m. And for the last however many weeks we've been holed up here, I believe we've had 100% attendance every single day on that call. And I don't know about my teammates, but I tell you, it's like it's a really important part of my day. I mean, it's a wildly important part of my day to get on with my team, and just as we are running out of things to talk about with respect to deals, we are just being together and talking to each other and giving each other a hard time, and abusing each other's haircuts and all that stuff is. I find it is more and more important. So that I appreciate you acknowledging that is as much of a topic as anything we ought to be covering.
Thanks, Tom. So we only have a couple minutes left, and we may even roll over a little bit. But Lindsay, I'm going to flip it to you for if you see some good stuff in there to throw at the panel.
Yeah, and Tom, I saw you open this, but I saw you already answer this, but I thought it was a good question. When the economy reopens, do you expect spreads to tighten?
Yeah, we're already seeing it. I mean, and I'll give you an example on the multifamily lending space. Fannie Mae and Freddie Mac a few weeks ago, prior to the government the CARES Act coming out, we saw base rate interest rates, 10-year Treasury go way, way down, but we saw credit spreads blow way out. And in the time that the CARES Act's been released, the government is buying back agency paper, AAA agency paper. We've basically seen a contraction of spreads on that agency side by 7,500 basis points. So you could borrow, if you had a good low leverage conservative loan, you could borrow under 3% today in that space. So yes, I would expect that to continue. And I think the banks are going to be the first guys back out of the chute in an aggressive way. Dylan, you can opine on that. I think the life companies are going to, go ahead.
Oh, I was going to say it's for us. It's a little bit different. It's like, you watched oil drop, to, I don't know what it's trading at now, but you're not necessarily seeing those savings at the pump. So it's kind of the same thing in our world. We're seeing, you're seeing rates drop, right? Cost of funds to the banks are dropping, but the spread in at least the traditional banking world, they're actually increasing. And it's somewhat counterintuitive, but when rates are high, we make all of our money on deposits. When rates are low, you have to pick up the spread on loans. And so we've actually seen spreads increasing as the rate environment, as we've been watching the rate environment decrease.
Yeah. I would just expect that banks would. Go ahead.
Mm-hmm.
Yeah. Go ahead. I'm sorry.
So, Scott, we've gotten a few questions around this, but basically, what's your take on what PE firms are thinking right now? Are they hunkered down? Are they working on cash preservation, cost cutting? And when do you think PE firms will get back to making new investments?
They are. There's kind of two sides to the conversations that we're having. There's no perfect portfolio where a private equity firm doesn't have a business that is not severely impacted by this in certain circumstances, and so they're absolutely spending a lot of time and effort and attention to portfolio companies that have problems, have issues that need to be figured out here in near real time, and that's absorbing a lot of resources. That said, the other side of the equation is that every day we get 25 emails from private equity firms saying we're in business, we're ready to go. And remember, over the last couple of years, while these private equity firms are raising record levels of capital, shattering the records, at the same time they're simultaneously saying that valuations are too high, right? Well, they just got the re-rate they were looking for. Obviously not in a form or velocity that anybody wanted to see. But it's there. So, animal spirits are always part of the capital game. And they're very, very aggressively looking to put that capital to work because it has to. And so, kind of tacking on to a previous comment, what we're seeing is that they're very eager to quickly, look at, again, minority deals where someone may have been looking at a majority deal in the past, looking at, kind of structured equity fixes to repair some balance sheets for good companies that are in a bad, period right now. But also, again, there will be businesses that do rebound, and I say that cautiously, but rebound and demonstrate resiliency to this type of shock. And we're seeing that with some of our clients that are doing, exceptionally well in this period of time in the situation. And so, the buyout game is going to be there. I just think it's going to be, subordinate to a certain extent for a period of time to the opportunity around, these near-term kind of fixie type of transactions that, candidly are going to result in potentially a new era of return for private equity as it relates to this situation. So, occupied with issues, but very, very much active and in the game. There's been no slowdown in pursuit from our perspective.
And do you see any industries that you see coming back with more strength and stability on the other side of this?
Yeah, I mean, again, so from my perspective on the consumer side, very obviously, the food and consumer staple businesses have done extraordinarily well, and they were high value businesses before this all went down, and I think that they'll be bolstered and supported by what they've been able to demonstrate in this period. I think across the industrial spectrum, there are going to be segments, energy, WTI at $17. I know we were looking at negative 36 the other day. That was a structural bust, but $17 WTI is nothing to stand up and cheer about. And it's going to be tough until that cycles, which it probably will, because it has historically done that. But I do think that businesses also that relate to the analysis of situations and viruses and impacts of disease on humanity, you might expect they're getting a lot of attention as well. And this is probably a very big support factor for those types of businesses. So I think again, the way we generalize it more so that companies that had a reason to be and were providing services and products that were central to the economy, broadly speaking, across the entire spectrum, they're going to come back and they're going to be viable again. They're going to have to figure out how to navigate some murky waters between here and there. But there will be, and I mentioned in my coverage universe, the independent restaurants who may have been fabulous businesses and part of the cultural zeitgeist of a particular community. The institutional capital will not be there for them unless there is a vaccine or something to substantiate fully that they won't be hit by a second wave effect, right? You're not going to see an investment committee take second wave risk on a location-based retail opportunity. That's not going to happen for the foreseeable future. So it's going to be tough for those smaller independents that don't have the balance sheet strength to weather through this. The alternative being that they'll have to personally finance their businesses, and that's a limited number of folks that could actually do that.
Well, we want to thank all the panelists. We appreciate y'all being here. We do have a takeaway question. We understand a lot of people might be dropping off, but really quick before we go, what is the most pressing thing on your mind? Let's start with Scott.
Similar to Bill, so we're client folks. Put our clients aside because we're always worried about them. Myself, my partners, we're worried about our employees, across the board. Worried about their state of mind. We're worried about the future. We spend a lot of time thinking about ways that we can help the people that are in our organization, because we are small and we are very much a family.
Tom, what about you?
Yeah, same thing. We have clients that we want to see succeed and they're having a hard time right now. As much, we have a young group of people who this is in the beginning of their career, and there's a sense of responsibility that comes with that. We really want them to be successful in this. I hope this is not too long of a pause button for them, because if it's not too long of a pause button and we can continue with their upward march, this will be an invaluable lesson, and that's what we want to see happen out of this.
Dylan, what about you?
Like everybody else, the health and well-being of our people is the most important. I mean, you can take our money and homes and all that stuff, but when it comes down to the risk of death, it's a different game. And I think it's important that we keep our culture together and we keep reminding ourselves that we can worry about what's going to happen, but it's going to make us miss all the good things that are happening in all this. I think there's a lot of great things that are coming to light right now, and we need to focus on that and how that's going to change our world, because the world is going to look drastically different in 6 months. Next time I see you, Bill, I'm probably not going to shake your hand. So even with no coronavirus, that's going to be what's going to happen. Like, the world's going to change. So it'll be interesting to see. Yeah, the bow.
I thought you were going to tell me the next time you see me, you'll be clean shaven.
So I told the team, just so you know, I told the team that I wasn't going to shave my beard until we get back to work. So this thing this thing's going to get gross, and then I'll be clean shaven. Hopefully by the next time you guys see me. So.
All right, Bill, close us out. What's the most pressing thing on your mind?
Well, as a lot of people on this call know, I'm very involved with KIP and chair the Texas board. The things that we face, those of us on this panel and most of the people who are participating, pale by comparison to the challenges of people in the lower income bracket of our community. And they're worried about feeding their children, paying for their Wi-Fi and their electricity, losing their housing, access to healthcare. It's so I have this sort of dual life that I live of, working and worried about our team at BoyarMiller and my clients and their survival. And then I get faced with 29,000 kids and their families every day of what we get to do to feed them and educate them and help them. And I'm just acutely aware of the challenges that are faced by our fellow citizens who aren't as fortunate as we are sitting in these lovely homes. And the demand on the philanthropic dollar in this community is so different than ever before. We had Harvey and the whole world responded, the whole country responded, and now the whole country is responding to their own problems. So our ability to take care of those who aren't able to necessarily take as good a care of themselves as we are is very limited. But in the face of that, people out on the front lines, not only our healthcare workers, but our educators are doing extraordinary things every day. And for that, I'm grateful, but it's something that worries me every day. But I also am an eternal half full guy. Built this business in my entire life on understanding that risk is risk and opportunity is opportunity, and you have to distinguish the two. So this too will provide opportunity, and I, like you, Tom, think this is going to be a great lesson for our young people, just like the one we got when we were in our late 20s and 30s. So
yeah, well, it's been a reminder that risk exists in the marketplace. Risks exist, by being alive. And if all we do coming out of this is accept that our lives are going to be inherently a little more risky than they were before, then that's okay.
Yeah. So we're both parents of millennials, and it's they've had a pretty good run. So.
Exactly.
Well, I want to thank you guys. I want to thank all of the people who participated. We had a good group. I hope you found this to be worthwhile. I certainly did, and really appreciate my friends getting on with me. And y'all be well, stay safe, and march forward.